Foreign investment into distressed debt in India has picked up of late. Tax considerations, as usual, play a very important role because post-tax returns are what the investors are interested in. And as foreign investors, they have greater degree of flexibility in choosing the vehicle, choosing the instrument, and choosing the jurisdiction from where they can invest into India. Foreign investors who are interested in distressed debt in India have various routes available to them. For instance, they can invest either through the FPI route, which is Foreign Portfolio Investor route, or the AIF route, which is the Alternate Investment Fund route, or the FDI route, which is the Direct Investment route. But we see a clear preference for investment into securitization receipts, which are issued by securitization trusts, which are run by asset reconstruction companies. And that's because there's a distinct tax advantage available to a securitization trust, which has not been conferred to other modes of investment. For instance, business income in respect of AIFs are taxable in India and they have not been granted a pass-through status, whereas a securitization trust is granted a pass-through tax status. A foreign investor stands to earn revenues in the nature of interest income, which is the predominant form of income derived from such instruments, or by way of an upside, which is basically a difference between the discount at which the debt is bought and the amount at which it is redeemed. Then the third revenue stream is the possible capital gains, where the investor, without waiting for redemption to happen, sells the debt instrument or the securitization receipt. Now, interest income can be taxed at a standard rate of 20% provided in the Indian domestic law, but there are opportunities of reducing this tax burden by availing a concessional rate of 5% provided in our own law. Now, this 5% concessional rate is subject to certain conditions, but where either of the conditions are not fulfilled, then treaty jurisdiction becomes important. But having said that, treaty benefits are now subject to an overarching test of substance requirement, anti-treaty abuse requirements. Now, as far as the upside is concerned, if the upside is earned on a debt instrument which has been subscribed directly through the FDI route, then the upside income thereon would be taxable as that of interest. And only in cases where the investment is made through security receipts issued by securitization trust, you have the possibility of saving taxes, because the tax status is dependent upon the characterization of income done by the securitization trust. In India, most of the securitization trusts have chosen to treat this income as business income. Now, in respect of business income, considering the tax treaties which India has entered with all treaty partners, a foreign investor can only be taxed in India if it has a permanent establishment in India. If it doesn't have a permanent establishment, it can't be taxed. But if one enters through a jurisdiction which does not have a treaty with India, then the concept which comes into play is the business connection test, which is provided in our domestic law and can get quite litigious with the tax authorities because it's not clearly defined and it's based on case law